Today is Sunday, January 17th, 2021, and I am your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the overall global macroeconomy. I know it's the middle of the weekend, but like I said in the last video, there is a lot going on in global macro that we do need to try to ultimately make sense of. So what I did here was I threw together a few slides here to summarize visually, what is the true state of the economy. Now, if you've been watching all of my videos, you know by now that capital markets are surging to record highs, supported by record low interest rates and massive deficits in a debt-based economy. And debt monetization is a global phenomenon. If you look at Italy's 160% debt to GDP and the fact that the ECB owns 30% of Eurozone member states' debt, in the US, there are still more than, there's still more people than the great financial crisis filing for claims. And now the U6 unemployment is at 12% from a 23% peak back in April. And all of this while the Dow is up 70% from its March lows. So, and let's not forget about the widening wealth gap between the rich and the poor, of which the federal government and central banks are, of course, the centerpiece of it all. I mean, the gap is so extreme that 70% of the world's population are in the sub $10,000 wealth range. This is commercial bank credit cards, consumer loans, which confirms there is no lending because banks have tightened up on lending like we've talked about in the past. So essentially what has to happen is bank lending slows down after there's an increase in the percentage of banks that tighten lending standards. So we saw this parity occur in the great financial crisis of 08. We saw it occur in 01, the internet bubble. And since the great financial crisis, banks have actually increased their share of outstanding loans, and the risk underlying securitization, it's definitely transitioned from banks to non-banks in the most recent decade. Now, this shows that taxes really do have to be raised in order to proportionately offset the explosive increase in spending. But of course, we know the risk is inflation because we owe so much debt, and we certainly can't tax the population to cover the debt. And this is because the debt is too big, which means we have to print dollars, which is what we have been doing, in response to tantrums and black swan events. But now it's the new normal to monetize the debt. Only the torch is being handed to the fiscal side because the Fed has exhausted much of their monetary expectation policies by buying up the Treasury market. And as Dr. Copper has been indicating, especially within the last 6 months, I would say that, we may go back to the 1970s inflationary period, but a lot of this copper the past year has been backlogged and hoarded due to supply chain disruptions. And this goes for a lot of commodities, just not just copper, and overall lack of labor participation and economically productive investments, the lack of, which most notably would be infrastructure spending, which is, it is the one kind of spending the government should pursue, but does not, and this is why deficits are only growing. And the Treasury has about $8 trillion of debt payments to service just this year alone, which is almost 3 times that of what Japan owes. This obviously puts the US in an extremely vulnerable position. That is, unless global fixed income funds decide to sell out of negative yielding debt and back into the Treasury market. But given the decelerating trend in foreign Treasury holdings since 2016, I think the demand side of the Treasury market is pretty manipulated, and it won't end well because eventually all of this debt must be paid back, of which the US federal government at least is nowhere near a position to do so. It would take at least 2 generations to pay off all this debt. And of course, this chart shows us the aggregate US dollar position, and clearly, well, you could see for yourself, everyone is crowded in net short, which means everyone is bond bearish, right? So of course, we know that there has been a pretty major downtrend shift in foreign holdings of US treasuries, and it's not necessarily selling for now anyway, but it's probably the fact that they're just not, they're just not buying as much in treasuries as they did in the pre-Trump election. And we obviously know that the Fed has been buying up the entire market, not the entire market, most of the market, creating that demand they need for treasuries. But with real rates temporarily rising and continue to potentially test even higher, and the fact that perceived real inflation is higher than the official CPI headline inflation, I think it will enable a good dip buy opportunity in precious metals. And I stress the word temporary, most notably in gold and silver, right? And I would also consider credit risk when the money supply in the US is growing 70% on an annualized basis. All right, that is just insane. So this is all I wanted to get into today. I have an exciting interview coming up extremely soon, and if you like this video, please hit the like button and subscribe if you haven't already. And of course, I am not a financial advisor, and everything I say is for informational purposes only. Okay, thank you and have a great rest of your weekend.